Exercise 2 here says the Caney Corporation would have had identical income before taxes on both its income tax returns and income statements for the years 2018 through 2021, except for the differences in depreciation on an operational asset. The asset costs $120,000 and is depreciated for income tax purposes in the following amounts: 2018 $39,600, 2019 $52,800, 2020 $18,000, and 2021 $9,600. The operational asset has a 4-year life and no residual value. The straight line method is used for financial reporting purposes. Income amounts before depreciation expense, notice that word, before depreciation expense, and income taxes for each of the 4 years were as follows. So again, accounting income before taxes and depreciation. So in other words, this 2018, it says $60,000. That does not include depreciation expense or income taxes. So keep that in mind. It is excluding depreciation at this point in the problem. Assume the average and marginal income tax rates for 2018 and 19 was 30%. However, during 19, the tax legislation was passed to raise the tax rate to 40% beginning in 2020. The 40% rate remained in effect through the years 2020 and 2021. Both the accounting and income tax periods end December 31st. Prepare the journal entries to record income taxes for the years 2018 through 2021. So let's start with 2018. Now, the cool thing is this would be 1, so this would be December 31st, 2018. Now the entry is very similar. It's going to be income tax expense, and we're going to credit income tax payable. Now, the difference between the two, what we actually have in expense on our income statement and what we actually pay to the government, that's the payable, would either create a deferred tax asset or deferred tax liability. Well, which will it be? When we look at depreciation, let's start with finding the actual depreciation rate for straight line. Remember, straight line depreciation would be the cost. So we would take the cost of the asset, find a spot to do that on, there we go. The cost of the asset's $120. There is no salvage value, so we would divide that by 4 years. So when we do that, what it's going to give us is the straight line depreciation per year of $30,000. Okay, now notice, what we expense on our income statement is $30,000. What we deduct from our income tax is $39,600. Now over time, they will equal out. So if we added up all 4 years here for tax purposes, it would also be $120,000. The problem is there's a timing difference between each one. So what that's going to create is a deferred tax liability because we're deducting more here on taxes. So that means in the future it's going to cost us more in taxes than what we have on our income statement. So we're going to actually go in and we're going to credit a deferred tax liability. That's what's going to be created in this instance. Now, how do we find each one? Well, remember, income tax is based on the accounting income. Income tax payable is based on taxable income. So the first thing we need to do is find out what is our income tax. Okay, so it tells us the pre-tax accounting income before taxes and depreciation is $60,000. So since we know that that would tie with taxable income, all we have to do is take out the depreciation for that period. So for 2018, what we would do then is take the $60,000 minus the $39,600, and that would allow us to calculate the tax. So let's create a little bit of space here so that we can do that. So the first thing we're going to do is to find taxable income. We're going to take the pre-tax before depreciation, which is the $60,000. Remember, that does not include depreciation. So we can take that minus the $39,600. Why do we not take the difference? We get to take the full amount because the $60,000 does not include any depreciation at all. So we get to take the full $39,600. That gives us a total taxable of $20,400. Then we multiply that by the 30% rate, and that gives us tax of $6,120. Okay? That's the amount we have to pay to the government, the taxing agency, okay? So that's going to be our income tax payable, $6,120. Now, to find our deferred tax liability or our income tax expense, in this case we could find either or and it would work out perfectly fine. So let's start with our deferred tax liability. Now, how do we do that? Well, it's going to be the difference between what we're allowed to tax and what we are reporting on our accounting income. So we're going to take the $30,000 in depreciation, okay, to find the difference. So depreciation, let's do it this way, equals, it's $30,000 for our accounting income. However, it's $39,600 for our income tax return. So that brings us a difference of $9,600. Okay, so that is a temporary difference. So that means eventually that difference is going to correct itself. So we're going to multiply that by the 30% tax rate. And when we multiply that out, it gives us $2,880. Now, we had no previous balance in our deferred tax, so that's actually going to be the amount of our deferred tax. Now, if we add those two together, it's going to tell us that our total tax then is $9,000. We can also check that through finding our accounting income tax. Okay, so we got our taxable for the government. Now we can find our accounting income tax. Remember, it said $60,000. Remember, that did not include the depreciation, so you're going to take that minus the $30,000. So that gives us $30,000 in accounting income times our rate of 30%, and that would give us the $9,000 in tax for 2018. Now, that was 2018. Now you can leave that, find a new spot. I'm just going to simply update it for 2019 so that we can see what we're going to do in 2019. Well, let's start by finding taxable income. Okay, so in 2019, let's get rid of this. We started out with $80,000 in income before tax and depreciation. So we'll find our depreciation difference there. Whoops. Forgot an A. There we go. And then we'll find our accounting tax here in a minute. But $80,000, remember that was before tax or depreciation, so we're going to take out the full $52,800 for our depreciation for tax purposes, and that gives us taxable income of $27,200. Okay. Now our actual tax rate that year is 30% still. Remember, it said that in 2019 the tax rate is 30% still. It switches to 40% in 2020, but in 2019 it's still 30%. So that's what we're going to find our tax payable on, and that gives us our income tax payable, the amount we should pay to the government, of $8,160. Now what are we going to do for our entry? Well, this is December 31st, 2019. As far as the debits and credits, they're going to be the same, okay? Because notice, this is way higher than the 30, so we're accumulating more of our deferred tax liability at this point. So we're going to go in and have more. So we know that that's going to increase. We are not using any of it at this point. How do I know? Well, notice, it keeps messing that up. But this year it was $30,000 for accounting purposes, $39,600 for tax purposes. This year again it would be $30,000 for accounting purposes, but $52,800. So again, we're deducting way more than what we have on our financial statements in depreciation expense. So that means that gap's going to widen this year. In other words, we're going to accumulate more deferred tax liability. But notice in future years that's going to reverse out and sort of undo that temporary difference, that deferred tax liability there. Okay? So that gives us the $8,160 in payable. Now, let's talk about the difference in depreciation here. So what we've got, again, straight line was $30,000 minus the $52,800 gives us a difference of $22,800. Now, That's in addition to the 96 we already had. Okay, so that's the balance minus, well, let's just do plus here, excuse me, the 9,600 we already had in the account. So that brings our total to 32,400. That's the difference cumulative between what we've reported on our accounting statements and what we have paid or deducted on our tax returns. Okay, so that's the cumulative difference. We're going to multiply that now. Here's the catch. This is a future difference. Well, what do we know is going to happen in the future? Our rate is going to change to 40%. I know this year it's 30%, but remember, when are we going to realize this deferred tax liability? It'll be in 20 and 21. Therefore, our tax rates in those 2 years are 40%, not the 30% it was in the past. So we need to find our new updated balance in this account. So if we multiply that out, that gives us a new updated balance in total deferred tax liability of $12,960. Again, this is the final balance in the account. When we have a tax rate change, you can't find the income tax expense and take the difference. You have to find the balance that needs to be in the deferred tax liability based on the 40%, and then take out what you've already got in the account. So we've already got 2,880 in there. So that means that this year we need to do 10,080. Now, there's no way for us to find the income tax expense except add the two together. Because when we have that tax change, what's happening is we've got to go back and make up for last year's difference. Okay, so here we were carrying this and thought we would have a 30% tax expense in the future, but that went up. So notice, since that's the case here, we're having to catch up a little bit from prior year and include 2019's in that number. So that's bringing it up just a little bit. So this income tax expense, we could not just take taxable income. In other words, I can't just go in here and say, well, 80 minus 30 equals 50, and then multiply that by the 30%. That will not work this year because we've got to catch up and push that 40% forward. So in the year of the change, the income tax expense becomes a plug figure, okay, to help us out. So in the year of the change, we have to sort of plug the income tax expense because we're catching up from prior years using a lower rate or a different rate. Sometimes rates go up, sometimes they go down. So we're using a different rate last year. So what happens is we have to sort of plug that in to catch up, that account up to the current year's rate. Okay, so that would be 2019. Now let's look at 2020. Now luckily that's our only tax rate change. So going forward we should be able to calculate these pretty straightforward. Alright, and then take that out. Now, next year it's going to be the 40%. So again, the entry is going to be very much the same. We're going to do our income tax expense here. And we're going to do our income tax payable. Now, notice what's going to happen though. Are we going to add to our balance in the deferred tax liability, or are we going to start using up that deferred tax liability? Well, notice it's 18 for tax purposes. It's going to be 30,000 for accounting purposes. Therefore, we're going to start using up some of that deferred. That temporary difference that we've created here is now starting to correct itself. So we're going to go in and we're actually going to need a debit to the deferred tax liability account. Now let's calculate that and see why that is. Well, again, go back to taxable income. This year, we earned 70,000. So again, you can look back up here. It says 70,000 for 2020 there. 70,000. Again, that was before depreciation. So we're going to back out the 18,000 in tax depreciation, right? What we can deduct on our tax return. That gives me taxable income of 52. Again, our new rate for this year and next year is going to be 40%. So that gives me a total of 20,800 in income tax that we have to pay to the government. So that's my income tax payable, 20,800. Now, deferred tax liability, We can do one way, or we can find the income tax expense. Let's do the same order we've been doing, the deferred tax liability here. So go up and let's find our change or difference in depreciation. So it was $30,000 minus $12,400. So notice our difference, or why did I say $12,400 minus $18,000? Sorry. And that gives us a difference this year of $12,000. Okay. All right. So now I lost my place there for a second. Now remember, that's $12,000 for the current year. Then we have to go back. What did we already have in there? Well, we already had $32,400. I deleted it, so that's the reason I was like, wait a minute, what was our balance before? So we have $32,400. So that brings us to a needed balance of, let's see, what is that? $20,400. So notice now the balance has gone down. So multiply that by the 0.4, and we're going to get what our new balance in the depreciation should be. And that is now $8,160. Now, how much do we already have in there? Well, we already have $12,960 in there. So we have too much. So how are we going to bring that balance down? Remember, deferred tax liabilities are credits. So if we add these two numbers together, we have the $12,960. We should only have $8,160. So to correct that balance then, I need to bring the account down by the $4,800. In other words, I need to debit the deferred tax liability for $4,800 because now we're starting to consume that deferred tax liability. Now, what's our accounting income tax? Well, again, we can solve that separately. So what we need to do then, what was our accounting? Our income again was 70 minus our accounting depreciation is 30. So that brings us to an accounting income before tax of $40,000. Then we're going to multiply that by the 0.4, the new rate, and that gives us $16,000. So that's the amount we would report on our income statement. Well, is that how much we need to balance? Lo and behold, if we put in $16,000, since there's not a rate change this year, we can calculate both numbers. Notice we've now consumed some of that. So 16 and 4 gives us the $20,800. So that difference, that temporary difference here, is starting now to be consumed or correct itself. That's the reason we call it temporary. Over the life of the asset, it works its way down to zero. So here, we've created the deferred tax liability. Now we're actually starting to reduce it because now we're having to pay more to the government than what we report on our income statement. All right. And the last year would be very much the same. So we're going to go in. The accounting income for the last year, I believe, is also 70, 2021, minus 9,600. And that's going to bring us to taxable of 60,400. Whoops, I need to update this, 2021. Then we're going to multiply that by, again, our rate hasn't changed again, so it's still the 40%. We multiply that out, we get 24,160. So to do this entry, again, the fourth one's going to be the same. So go down here, December 31st of 21. The debits and the credits are going to be the income tax and the payable. So again, let's prove out that we're doing the deferred tax liability here. So we just came up with the payable as of 2021 to be $24,160. So $24,160. Now, we can either find the expense or the liability. Let's follow suit with what we've been doing and find the liability first, what we're consuming here. All right. So again, $30,000 for income statement purposes, $9,600 for tax purposes. So that brings us to a difference of $20,400. Okay, that's our difference this year. Now, our previous balance was $20,400. Notice, remember when we found it a few moments ago, that was our balance. So what should our new balance be? Well, there's no difference at this point. We fully made up the difference. So 0, if you want to really follow this out, times 40%. 0 times anything is 0. So at this point, the balance in our deferred liability should be 0. Well, what do we already have in the account? Well, we've already got $8,160 in there. Okay, so that means we need an $8,160 debit to close this account out to make it 0. So go down here, we're going to debit for $8,160. Now, of course, we could back into our income tax expense, but let's prove it. How much is our income tax expense? We have no rate changes, so we don't have to catch up anything or do anything weird there. So again, $70,000 minus $30,000. This year, our accounting income happens to be $40,000 before tax. Multiply that by the 0.4, and again, you get $16,000. Well, is that the amount we need to balance this account out? Well, let's hope. So if we go in and put 16,000 plus 8,160 does give us 24,160. So we balanced out. So notice, over the 4 years, we fully worked our way back to 0 with the deferred tax liability. In the first 2 years, we created it because the depreciation expense for income tax purposes on our tax return was greater than the deduction we could take on our accounting financial statements. But then later in life, what happens? Well, it flips. Because here, in these last 2 years, we get to deduct less on our tax return than what we report on our income statement. So that uses up that deferred tax liability. So hopefully this helps you see how we do the entries and what we do if there is a change in rates. Be very careful with how the problem gives you the income. Here it says income before taxes and depreciation. In other words, they have not yet removed any depreciation from these numbers. So that allows us to take out the full amount of the depreciation in both cases. When there's a tax rate change, in the year of the change, when we know it's effective, we have to back into the expense because we have to catch up the deferred tax liability, because that rate in the future is not going to give us the same benefit or cost us the same expense as it did in the prior year. So basically this number catches up for not only 2019's information, but it goes back and applies that extra little bit of percentage to the prior year so that it sort of is a catch-up year. So in that year, we have to be careful with our income tax expense.